Well, right now the market is in a holding pattern, which makes a lot of sense considering that we've had the recent rise in the yields. And even though they've come off, it's not been to any great degree. The bond buying program by the Federal Reserve, even though they're saying they're going to continue it, we really haven't seen a lot of evidence in it. If you look at the junk bonds, which was a place where the Fed was buying bonds, was the high yield companies and the high risk companies, that has come off. It's sitting right at a precipice right here. And the market's looking for the stimulus, the $1.9 trillion package, which even though it passed the House, I think there's issues in terms of whether or not it's going to sail through the Senate. And so the market's optimistic because we're seeing lots of good news about vaccines and lots of Americans that have already had the vaccine and the anticipation that everything's going to reopen in the next few months on one level. And on the other level, we have the fragility of the employment situation in the United States with the unemployment numbers coming out this Friday, and the Fed's focused on that. And so if we can't get through this next little hump of potential danger with the economy and the labor market, and we don't get that money coming in and the Fed doesn't come in or something, it could go down. So right now we're sitting like right there near the highs, but like I like to say, the floorboards are creaking a little bit. And the fear of inflation, I think, is not really showing up in the classic ways, which is why the Federal Reserve is saying that they're not really worried about inflation because they're looking at oil, which hasn't, I mean, it's firmed, but it's not skyrocketed by any means. Certainly when you compare it to what it was doing the last time we had inflation, which was 40 years ago. What I'm saying is that the inflation fears that we've been seeing, more food-based, industrial metal-based, hasn't really at this point impacted the gold market. And yet at the same time, you also have the yields rising in the dollar firm recently, which is going to be somewhat negative for gold. But I wouldn't discount gold completely. At this point, it seems to maybe have found a little bit of support at these levels at around 1,700 an ounce. And I would think that, I was kind of thinking maybe it could drop another $100 and then it would be like a bargain. But even if it holds here at 1,700, there is some buying coming in right now, especially, again, if the stimulus passes or if the Federal Reserve makes any kind of announcement in terms of buying back bonds and controlling yields. So I wouldn't give up on the yellow metal just yet. It's just been something that people haven't really been paying attention to because they've been busy buying equities and they've been buying some of the soft commodities and the industrial metals instead, like steel and copper. And Bitcoin as the sort of bizarre hedge for inflation, which would only work so far until it becomes more standardized. So yeah, I'm looking at gold right now as a potential. No skin yet, but we're looking. It's a day-by-day situation. If you're already in positions from the beginning of the year and you've taken profits, which I assume you should have if you haven't, and you have, then maybe I would be a little bit more patient here before I would start piling up. But I would think about the areas that will benefit from an economy opening up. And so that's why the transportation is still hot on the list. And even though we still have electric cars and electricity demand, and we're still looking at 3D printing, and we're still looking at solar stocks, et cetera, it looks like the energy, traditional energy, is more interesting at this point. And of course, we're still looking at these food commodities and particularly some of the ag tech companies that are sort of floundering here, but doing very, very well. Blockchain technology. I think you have to pick your trend that you like. And then when you start to see, let's say, transportation holding up the market or the Fed coming in through the junk bonds, those two areas are really good to look at. Then you can go in and buy and put your stop against recent lows. Well, there are some biotech stocks that have just been beaten up to a pulp that are good companies, like Gilead comes to mind immediately as a company that has been beaten to a pulp, but AstraZeneca, and we haven't heard very little except for when a good trial passes or it doesn't. You always have that danger in biotech. You get into a company, for example, Bluebird was a company we were in, we got out of, and thank goodness, the thing reported horribly, or they had a trial based on sickle cell anemia that went bad. Boom, that stock came in 30% lower and just tanked. So I would say with biotech, if you're looking at the ETF, Right now, it's sitting right inside the huge range it had last week. I would probably give it a little bit of time here to see if it can hold up. But again, always know where your risk is. So if it breaks down underneath last week's low, then I would not want to be long.